Good afternoon, everyone. I'm Kailun Zhang from CUHK, and thanks for having me tonight. And I'm going to introduce the paper, Like a Moth to a Flame, Do Stock Market Bubbles Exacerbate Credit Risk of Peer-to-Peer Lending? And this is a paper joined with Xin Liu and Zhigang Qiu from Renmin University and Xiaoran Ni from Xiamen University. And why are we interested in this question? Since P2P is one of the representative forms of fintech, and although fostering entrepreneurship and small business development by providing a flexible alternative to traditional banking, P2P could also amplify financial risks and destabilize markets. And here is one example from China. Following the stock market crash in China, the year 2015 also witnessed a wave of bankruptcy in China's P2P industry. More than 1/3 of the P2P platforms have become problem platforms in the year 2015. And interestingly, borrowers' profiles are largely similar before and after the stock market turmoil. And our conjecture is that maybe non-fundamental shocks in stock markets could transmit to P2P markets, increasing credit risk on P2P loans, because market booms may trigger retail investors to invest more in the stock market. However, due to the liquidity constraint from the traditional financial system, retail investors might seek P2P platform as an alternative source of leverage. And when the market suddenly busts, and the retail investors are left with insufficient funds to meet the loan obligations. Therefore, it leads to credit events on the P2P platforms. And this is our explanation. And we have the following findings. We empirically test the hypothesis by exploring information of more than 450,000 loans on Renrendai, which is a leading P2P platform in China during the booms and busts of China's stock markets around 2015. And we have the following findings. First, both the number of loans and the RMB volume of loans increased with the Shanghai Stock Exchange Composite Index. Second, both default rate and delinquency rate have a disproportional jump for loans borrowed above the 3,500 threshold of the SSE Composite Index. Third, the main effect is more pronounced when loan quality is lower and investors are more overconfident. Fourth, when the SSE Composite Index exceeds 3,500, there is a disproportional increase in interest rate and the fulfillment time needed to achieve the target borrowing amount, and also a disproportional decrease in borrowers' credit score and the loan amount. Why are we interested in China's P2P industry? First, it is indeed very important. China's P2P industry, once the world's largest, was one of the riskiest and least regulated slices of the nation's sprawling shadow banking system. Second, different from the US, due to the underdevelopment of the economic infrastructure, Chinese P2P platforms play a much more significant role in society. Due to the underdevelopment of traditional banking system, credit system, and law enforcement system, actually Chinese P2P platforms contribute a lot to the traditional consumption loan area. Third, Chinese P2P lenders are mostly individual investors who seek short-term capital gains and use the platform as a speculative investment tool. And due to the time pressure, they actually simply pay attention to interest rate and pay little attention to credit ratings. And here is a snapshot of the user interface of Renrendai. As you can see, on the left-hand side, you can see brief information like the unique loan ID, interest rate, and duration. And the orange button means that this loan, you can still bid for this loan. And the gray button means that this loan is already in progress. If you click into one specific loan, you can see detailed information like the loan amount, next repayment date, and borrower's information like user ID, credit rating, age, education, marriage status, historical loans, and borrower's income, house, mortgage, car, and car loan information. There are also some anecdotal evidences that support our story. In late 2014, driven by the bull market sentiment, a number of P2P platforms began to operate the equity allocation business online, stimulating investors to borrow money through online P2P lending to trading stocks. For example, the standard financing ratio on P2P platform is 5 times. If you have $1,000 in your stock account, you can borrow another $5,000 to buy additional stocks. However, the maximum financing ratio for margin trading account is only 60%. Therefore, the condition on P2P platform is extremely attractive for retail investors. Also in June 2015, just before the stock market collapsed, borrowing from P2P lending peaked at about 200 billion RMB. And to make things worse, essential investor education and proper risk warnings are missing. For example, one P2P platform even posted the slogan that I pay, you invest, and all the profits go to you. We also need to go through some institutional background information. China's stock market has become the world's second largest. However, unlike the US market, China's stock market is dominated by retail investors. For example, retail investors contribute 85% of the daily trading volume. And up to February 2021, retail investors take up 99.77% of the total stock amounts. This is a very shocking number. And we need to review the market crash in the year 2015. From June 2014 to June 2015, prices in the Shanghai Stock Exchange increased more than doubled, peaked at 5,178 in mid-June. But the market took a dramatic nosedive since June the 15th. And by July the 9th, the Shanghai stock market had fallen by 30%, which means that about 1/3 of the market cap vaporized. And more than half listed firms, which is about 1,400 firms, filed for a trading halt to prevent further losses. So this is a very remarkable incident in the year 2015 in China. Meanwhile, the P2P lending industry in China has experienced the most drastic developments and destructive busts. However, regulators did not set regulatory standards until mid-2016, and the lax regulation allows the P2P platforms to operate in extremely risky shadow banking areas. And there are a lot of credit incidents in 2015, for example, the 2015 P2P platform bankruptcy crisis. And given the evidence above, Renrendai, one of the largest P2P platforms in China, could be arguably considered as one of the shadow financing platforms. Renrendai is one of the first P2P platforms in China, and it was among the top 100 internet firms and the Hurun top 100 financial firms in China. As we can see from this figure, the red line shows the total number of loans in Renrendai, and the blue line shows the SSE composite index. And we can see a king point here. And the black line indicates the outbreak of the market crash in 2015. From this figure, we know that the accumulation in the total number of loans from Renrendai slowed down dramatically during the stock market turmoil, from over 40,000 applications per month to less than 10,000 loan applications per month, so that they are tightly correlated. And now we come to the data. We use hand-collected Renrendai data from its website, and the stock data is from SISMA database. We also use China's 3 factors from Stambo's website. In terms of the data filter, the sample period is January 2013 to December 2017, because we require that all the loans must be matured by 2020. and we focus on the successful applications. And in our final sample, we have 470,228 loans in our sample. And here are some summary statistics. Yeah, in Renrendai, all the applications go through an auction process in which lenders bid for interest rate, duration, and loan amount. And all the loans are fulfilled very quickly. As you can see, the log fulfillment time is about 3.3 on average, which means that it takes you only roughly 30 seconds to raise funds on Renrendai. And we can see some summary statistics about the borrower constitution. The borrowers on Renrendai are mainly young, male, and white-collar borrowers with low education level. We furtherly test the correlation between Renrendai lending and stock market by running regressions. And we find that both the number of loans and the volume of loans increase with the SSE Composite Index, indicating that stock market performance boosts the demand for P2P borrowing. And to provide causal evidence, we look into the change of investor attention. Existing literatures show that investor attention will trigger enthusiastic investment decision and also concerns from the retail investors. Anecdotal evidence suggests that investors take the SSE Composite Index reaching 3,500 as a starting point for a promising bull market. And the SSE market surpassed 3,500 soon after the 2015 China's National People's Congress and Political Consultation Congress. And meanwhile, mainstream media describe it as a sign of new round of market boom and reported it broadly. And also they describe it as a main achievement of the Chinese government. Due to the nature of high retail participation in China's stock market, as I mentioned before, Baidu search index is arguably a good proxy for retail investors' attention. Baidu is the major search engine in China, and it is the analogy of Google search index in China. Yeah, we look into the Baidu search index and find that the searching volume on the keyword market boom almost tripled from 525 on March the 15th to 1,427 on March the 17th. And we conclude that above 3,500 index can attract a disproportionately high level of retail investors to invest into the stock market. And also many market commentators regard 305,000 as a level for the index that Chinese authorities aggressively defend, because on March the 15th, the SSE index surpassed 3,500 for the first time in the past 7 years. Thus, the discontinuity of retail participation around the 3,500 index level can serve as a regression discontinuity cutoff to test the relation between stock market bubble and credit risk in the lending market. And we also treat it as a quasi-exogenous cutoff point. Yeah, to furtherly visualize the variation in the investor attention, we plot the Baidu search index on the SSE Composite Index. And we can see that in this graph, there is a structural break after the SSE index hits 3,500. And we also look into market participation measures like the new account established and number of transactions, net settlement value. And the new account created is an indicator that more new investors join stock market. And the other two measures shows that investors trade more aggressively on the stock market. And all these three measures show that the market participation rises suddenly. And we conclude that Baidu Search Index and market participation have a disproportional relation with the SSE Composite Index. We also run a time series regression, and it also confirms our conjecture. Investors exhibit a disproportional level of attention when the SSE Composite Index is above the 3,500 threshold. As you can see in this table, the coefficient on index are significantly positive. And when the index is higher than 3,500, which is shown in the interaction term, the search index rises more quickly. And here we come to the RDD setting, and this is the baseline result. We designed the following RDD setting, in which the left-hand side is the measure of credit risk, and we use default rate and delinquency rate to measure credit risk. Delinquency rate is the percentage of months in which the borrowers have delayed repayment, and the D is the dummy indicating whether the time of the loan origination has a stock market index higher than 3,500. And P here indicates the polynomial terms. U here is the residual terms. And we find that both default and delinquency have a disproportional jump for loans borrowed above the 3,500 threshold of the SSE Composite Index. Specifically, the default rate will rise about 1.4% after the index hits 3,500, and delinquency rate will rise for 2.1% after the market boom. And we will see this pattern more clearly in this RDD graph. On the left-hand side, we graph the default and SSE Composite Index, each in a bandwidth of 100. And we can see that around 1,500, there is a structural break. And after 1,500, the default risk is much higher. And we can see similar results when we measure credit risk in delinquency rate. We furtherly look into some cross-sectional variation, and we focus on loan quality and overconfidence. Here is a table about the borrowing time. We define working time as 9 a.m. to 5 p.m. from Monday to Friday. And we think that loans during the working time are more likely to be related to job issues. And loans during non-working time are more likely to be related with sentiment. And we find that the loans during non-working time are about 2 times more likely to default compared with loans originated during working time. And results are similar when we measure credit risk in delinquency rate. And we also partition the full sample into 2 subsamples based on the median of the number of words in loan description. And the detailed subsample means that the number of words in loan description is over the median, and brief subsample means that the number of words in loan description is less than the sample median. And we find that the default result in the brief subsample is about 7 times of the detailed subsample, which shows that the results are stronger among loans with lower quality. Here we come to our measure of overconfidence. Existing literatures show that male and younger investors are more likely to perform overconfidence in decision making. And if we look into female and male borrowers, we can also see similar results. Male borrowers are 2 times more likely to default compared with female borrowers. And also, if we partition the sample by the median age of the borrowers, we can see that young borrowers are about 3 times more likely to default compared with elder borrowers. Since the results mainly come from the subsamples consisting of young borrowers and male borrowers, we conclude that overconfident borrowers are more likely to default during this market boom. And here are some further discussion about some other loan characteristics, like the interest rate, credit score, fulfillment time, and loan volume per lender. Loan volume per lender is the contribution to the loan from each lender. And we find that the interest rate and fulfillment time rises aggressively during the market boom. And also the credit score and volume per lender drops suddenly after the market boom. So that there exists a disproportional increase in interest rate and fulfillment time, as well as a drop in credit score and volume per lender, driven by increasing borrowing activities on the platform. We conclude that the market becomes more crowded and the market condition is worse off. Next, I will wrap up and quickly conclude. The contribution of our paper is that, to the best of our knowledge, we are the first to identify stock market bubbles as an important risk factor in P2P markets. And we find that this link is established through the contagion effect between stock market and the fintech platforms. Our paper also has important policy implications on financial stability under this new fintech era, because many other emerging economies share similarities with China regarding weak investor protections and immature financial system, so that our research will shed light on the trade-off between how to cultivate financial innovation and how to maintain the financial stability. And I will briefly review the findings of our paper and conclude. In this paper, we established a causal link that stock market booms can stimulate risky investors to borrow money from online P2P platforms, which increases the overall credit risk in the P2P lending market. Specifically, credit risk in the P2P market increased disproportionately for loans borrowed above the 3,500 threshold. And we find that the P2P market becomes more crowded during the market turbulence. Now, that's all for my presentation, and all questions and comments are welcome. Thanks.